Hello everyone and welcome back. In this video, we're going to be taking a look at 20 of the most common hedge fund strategies which you will find at some of the world's leading hedge funds. And don't forget to stick around till the end of this video where I'll show you where you can download all the materials from this video. So let's begin. One of the most common strategies is what's known as long-short equity. This is one of the most common trading strategies, and pretty much it involves buying a stock which you think is going to appreciate in value and then simultaneously shorting another stock which you think is going to depreciate in value. So for example, let's just say that you are long Tesla because you think that technology is going to improve the industry, and then you're short GM because you think old vehicles are outdated and they're going to lose value. So this particular trade, it's only going to be profitable if Tesla gets more value or appreciates more than GM, or vice versa, if GM loses more value than Tesla. Now, when it comes to long-short equity or pairs trading, as it's sometimes known, it's more about relative value than a stock beating the market. So here, we're more concerned that Tesla is going to outperform GM, or GM is going to underperform Tesla. We're not so concerned about Tesla beating the market or GM beating the market. Here, it's all about relative value. Now, let's move on to another hedge fund trading strategy. And this is more of a niche strategy because only a few hedge fund managers out there actually get this right. And this is short-only hedge funds. So some hedge funds, they specialize in just going short, in just shorting a particular stock. Now, short-only funds rely heavily on financial modeling, deep dive into the company's fundamentals, in trying to identify if a company is just BSing, that if they are overstating their accounts receivable, that if they have committed fraud in their books, if they've been cooking the books, if management has been overspending, if the company has been mismanaged. So you really need to understand your particular sector, and you really need to understand the whole business structure in order for you to be really successful at identifying particular shorts. Now, the problem with shorting stocks is you have two main issues. Number one, you incur borrowing costs. Essentially, when you are shorting a stock, you first have to borrow it, sell it, and then eventually, after the stock goes down, you buy it back, and that's how you make a profit. Number two, you are susceptible to short squeeze. Essentially, what a short squeeze is, it's when you force short sellers to have to cover their position, and you pretty much inflate the market. Now, the problem with short squeeze is the fact that you can lose a lot of money, and you can pretty much just take a look at Bill Ackman, and he was caught on the wrong side of the Herbalife trade when he was up against Carl Icahn. So let's move on to a different strategy. Now let's take a look at the opposite of a short-only fund, which is a long-only fund. Pretty much very plain, vanilla, long-only fund. They only invest on the long side. Not much to say about this. And there are a lot of funds which just specialize in just long-only. So now let's move on to a far more exciting strategy. And this is event-driven and global opportunistic. Now, in terms of event-driven strategies, this is very broad because you tend to find a lot of global macro strategies, which we'll talk about later on, but a lot of global macro strategies, they tend to be very event-driven by nature. And event-driven, what this means is essentially when you wait for a particular catalyst to take place in the world or an event. For example, Brexit or COVID-19. Whenever something like this happens, it creates an opportunity in the market. So for example, with COVID-19, when pretty much every government imposed a lockdown on every nation, preventing people from leaving their homes. This means that no one is going to be traveling, so no one's going to be using their cars, no one's going to be flying on planes, so demand for oil is going to go down. So if demand is going to go down for oil, then price has to go down, and if price goes down for oil, then oil futures is going to collapse. And then, like we saw, oil futures went down into the negative territory. So whenever you're talking about event-driven strategies, it's pretty much they pretty much depend a lot on what's happening around the world. They need a catalyst in order to justify a particular trade. And once they identify the particular catalyst, now it's all about structuring the trade. What's interesting about event-driven strategies is that a lot of global macro funds, so funds which invest in fixed income, commodities, and currencies, they tend to be event-driven by nature, by the history of their trade, but they don't call themselves event-driven. And that's because whenever they're going to raise capital from investors, there's a lot more capital to be raised if you categorize yourself as a global macro fund, as opposed to an event-driven fund where there's not that much capital. So you often find a lot of global macro funds, they're actually heavily involved in event-driven, but they just call themselves global macro or opportunistic fund or multi-strat funds. But if you are interested in learning more about these particular strategies in a lot more detail, actually see examples and know exactly how to structure a particular trade, as well as the whole A to Z of the asset management world and the hedge fund world, then do check out the asset management and hedge fund interview and recruitment guide, where we pretty much break down the whole A to Z of the industry, from what you'll be doing on a day-to-day basis to strategies, to structuring your trade, and to even structuring a pitch in order to ace your interviews, as well as going over interview questions and answers. So do check that out, and I'll leave a link in the description below. So let's move on to another strategy, and let's take a look at activist investing. Now, activist investing is pretty much the opposite of passive investing. Passive investing is pretty much done by most hedge funds. Now, typically a hedge fund or even any regular type of fund, they're very passive in nature. So they will invest in a particular stock, in an index, in a fixed income security, and then they'll just wait for the stock to get repriced. Right? That's very passive. Now, activist investing, on the other hand, is very different. This is when a hedge fund will buy a controlling stake in a company, and then they'll get a board seat and then go and actually force the board to take different actions that will make the stock price higher or to appreciate. Now let's take a look at a relatively new strategy which has come up in the hedge fund world, and this is Sharia compliant hedge funds. And essentially what Sharia compliant hedge funds is, it's a hedge fund strategy which is compliant with the Islamic religion. If you take a look at the Middle East, it's famous for two things. Number one, oil. Number two, money. Now, something else which is interesting is that in the Middle East and in parts of Northern Africa, Islam is the dominant religion. And as a consequence, there are criteria in terms of investing. So if you do follow the Islamic religion, then you're prohibited from investing in interest-bearing securities. You can't go short a stock, and there are other requirements such as industries which you cannot invest in. Now, typically traditional hedge funds, they don't cater to that. And as a result, there's been a new birth of hedge funds which cater predominantly to that particular market. And they're known as Sharia compliant hedge funds. And you'd be surprised, but there are a lot of them right now. And if you go into places like the Middle East, North Africa, Southeast Asia, like Malaysia or Indonesia, it's a really booming market. And even in London, Europe and the US, they're trying to attract that capital. So they are starting to cater to that. In London, one of the biggest Sharia compliant fund is Oasis Crescent. They have tens of millions under management. So it's a really booming market. So now let's move on to number 7. I think we're number 7. And let's take a look at global macro. Now, as I've already alluded to before, global macro as a strategy is very broad. But predominantly in the global macro world, you're trading FIC. Now, FIC stands for fixed income, currencies, and commodities. And essentially, in this world, in the world of global macro, a lot of the strategies tend to be event-driven. But you also have other strategies which is in the global macro space, but you're pretty much in global macro if you're trading indices, fixed income, currencies, anything which is not stock related. But even that, some global macro funds would even trade stocks as well. What separates global macro from other strategies is capacity. Now, whenever you have funds which manages tens of billions, hundreds of billions, and in the case of Bridgewater Associates, which manages over 170 billion, they have a problem of capacity. You see, if they were to invest in stocks, and let's just say they want to invest in a company whose market cap is 500 million. Now, they have 170 billion. There's only so many of these companies that they can invest in, or that they can actually find enough shares that they can buy or sell. So there is a capacity constraint. But when they are investing in global macro, they don't have that constraint anymore, because you can pretty much buy as much currencies as you want, as much commodities as you want, as much indices as you want, because the market for indices, currencies, commodities is huge. The world of fixed income it's huge. It's in the trillions. It's not like in the billions for equities. In the world of commodities, fixed income, currencies, we're talking trillions of dollars. So you have a lot more capacity to trade with. So whenever you have funds which have 10 billions of asset plus, they tend to be they tend to be, not always, but they tend to be very macro driven. What's unique about global macro traders versus equity traders is the difference in knowledge. If you want to go into the global macro space, then you need to have a very good understanding of economics, geopolitics, and current affairs. Versus if you want to go into the equity world, then you need to understand capital structures, equity valuation, financial modeling. You need to understand that, but it's very different in the macro world where it's pretty much very current affairs driven, economics driven. So depending on your interest, if you are far more interested with current affairs or economics, then you will naturally gravitate to global macro strategies. But if you're far more interested in the business world, in the deal making space, then you might go into the M&A arb or equity strategy direction. Okay, so now let's move on to strategy number 8, which is market neutral. Now, this is very interesting because one of the best performing hedge funds is by Citadel, and one of their flagship funds actually is based on a market neutral strategy. Now, essentially what market neutral is, it's when you target a zero beta. So when your portfolio has nearly zero correlation to the market. And the way you achieve this is, let's just say, for example, you have a portfolio of $100 and you buy a bunch of tech stocks. So you then leverage your portfolio by 100% and then you go short healthcare stocks, right? So you have $100 long tech stock, $100 which you've leveraged, and you're short healthcare stocks. So you effectively $100 long and $100 short. So your gross exposure is 200%, but your net exposure is 0. And as a result, because of the long and short in equal proportion, your beta exposure, so your exposure to the market, your portfolio's exposure to the market in terms of direction is 0. And that's how you achieve market neutral. So let's move on to number 9. And this strategy is called fund of funds. Essentially what this type of strategy involves is, it's when a hedge fund invests in other hedge funds, other venture capital funds, other real estate funds, other private equity funds. Now, some of these fund of funds will specialize in just hedge funds, but essentially the fund manager in a fund of funds strategy, they're not really selecting or buying stocks. Instead, they're selecting and buying other hedge funds, other hedge fund managers, because they want to achieve diversification. And that's just their aim. So they want to invest 10% of their capital in 10 different types of funds. And that's essentially how they make their return. Okay, so now let's move on to number 10. And now let's take a look at quant funds or quantitative funds. Now, these types of hedge funds, they tend to be very maths heavy, very financial modeling heavy, very algo heavy. They're not like your traditional or typical research, and they pretty much invest in a handful of stocks per year. These types of funds, well, depending on their trading frequency, can be in and out of hundreds of thousands of stock in any minute. There are 3 important characteristics whenever we're talking about quant funds. Number 1, it's the trading frequency. Now, you have some quant funds which are very active, and these are high frequency funds. So essentially what a high frequency fund is, they will invest and they will trade in and out of securities maybe hundreds or even thousands of times, and this can take place within a matter of minutes, seconds, or even nanoseconds. But then on the other hand, you have other types of funds which are low frequency, and they may trade 1 or 2 stocks within a day, within an hour, but they're much more slower than the high frequency fund. Another thing which is important is the trading venue. Now, some funds, they pretty much trade on a particular venue. Some will trade in the dark pool. Finally, the third thing is operational costs. Whenever you go into a quant fund, one of the biggest expenses that they incur is the infrastructure cost. Because think about it, in order for you to build one of these platforms or one of these venues, you're going to have to invest heavily on technology. So building these supercomputers that can handle these complicated algorithms, that can handle all this data being pumped through it. And even the human capital, you have to invest heavily on getting really smart people into the door to actually build these algos, to actually maintain the algos. So it's very, very capital intensive to begin with. And as a result, they're going to have to leverage a lot of their trades in order to justify, number 1, making the returns to cover the operational cost, and then making a return for their investors. So even though they might make pennies on some of their high frequency trades, but because they're leveraging those trades, it does make sense when you add them all up. Okay, so now let's move on to number 11, which is fixed income. Now, the fixed income space, some hedge fund managers, they specialize in just investing in fixed income securities. It's a very boring area, not as fun or as exciting as equities or global macro, but it's one of the largest markets out there. There's a lot that can be said about fixed income because it's not as simple as just investing in bonds. You have convertible notes, and this is a really good strategy which is used in M&A arb. So there is a lot of overlap in terms of fixed income and other strategies as well. So like global macro, which is again fixed income dominated. You have M&A, which can be fixed income dominated if you invest in the right capital structure. But again, fixed income, it's a world of its own because of how huge the market is. So now let's move on to number 12, and let's just take a look at distressed investing. Now, some hedge funds, they invest in just distressed companies. Whenever a company runs into trouble, they are either about to go into bankruptcy or they are currently in bankruptcy proceeding. You then have some hedge funds that will step in and provide capital that they need in order to restructure their balance sheet or get out of the mess that they're in, or to pay off certain creditors so that they can restructure their business and emerge profitably. Now, some of these hedge funds, they will pretty much go into these situations. Now, this is a very high risk scenario because, again, these companies, they are on the verge of bankruptcy. So you are taking a risk by investing in these companies. But the good thing is, with a high level of risk, there's also a high level of reward because you can pretty much buy these companies for pennies on the dollar, both on the equity side and on the debt side. So there's a lot of reward to be had on both sides of the capital structure. And it is a very niche area. You do need to know a lot about bankruptcy proceeding, bankruptcy law, financial modeling. You do need to understand how to restructure a business, the likelihood a business will emerge profitably out of bankruptcy. You do need to have that specialized set of knowledge in order to operate in the distressed investing world. So now let's move on to the 13th strategy, and this is merger arb, or merger arbitrage. Essentially, this strategy is all about taking advantage of mergers and acquisitions. Whenever a company announces that they're going to acquire or buy another company, and they have a share target price in mind, so say for example, Google or Alphabet announces that they want to buy ABC for $6. And let's just say, for example, ABC has been trading at $4, but the moment that Google announces that they want to buy for $6, instantly that stock is going to jump to around $5.50. Now, there still is that difference between $5.50 and that $6 target, and that's the upside which merger arb traders are targeting. Essentially, if you're in the merger arb space, you are essentially buying shares in the hopes that this acquisition is going to go through, and that essentially this ABC share at $5.50 is eventually going to go to $6. Now, the problem with this is your upside is known, which is great. So you know that in the best case scenario, you are going to make that extra 50 cents. But the downside is much bigger because you could potentially go back to $4. In terms of a risk and reward strategy, it's not really good because your upside is 50 cents, but your downside is around $2 or $1.50. Now, this is the issue which merger arb traders faces. So it's all about making sure you don't take extra risks that you don't need to. Now, if they do make a mistake, this could potentially set back 6 trades. Not all merger arb traders trade equities. Now, I know that for those of you that do know or who are familiar with the merger arb space, then you might have heard that it's all about the equity, it's all about buying the shares. But some traders will actually buy the debt or the convertible note. So instead of only targeting that 50 cent upside, if you are buying the convertible note, you can get a much bigger upside. Now, if you do want to go into this space, then you do need to have experience in investment banking or in the M&A space, because you do need that experience, that knowledge in putting deals together, in knowing if a deal is going to materialize or if it's going to flop, or if regulators are going to come in and prevent the deals from going through in the first place. So you do need to know how deals are structured, capital structure, the potential upside. You do need to be aware of restructuring laws. You do need to understand the likelihood, or you need to have the experience to know whether a deal is likely going to go through or not. And this is why a lot of ex-investment bankers tend to go into this strategy, because it suits their background. So now let's move on to another strategy. Now let's take a look at credit arbitrage. Now this strategy should not be confused with fixed income or fixed income investing. Here you're essentially trading the spread. So let's move on to another strategy. Now let's take a look at a relative value. Now, relative value is very interesting because in the world of global macro, and even beyond global macro, even in the equity world, in the fixed income world, a lot of assets tend to be correlated. For example, oil and natural gas, they tend to be very correlated. Gold and silver, they tend to be very correlated. So if gold moves up, silver tends to move up as well. So this provides an opportunity. For example, if in a day gold moves up a lot, let's just say by 5%, but silver hasn't. Now, because of this widening in the price difference, in the spread, but you do know that eventually it will have to go back to normal. Eventually, silver will have to either go back up or gold will have to go back down, because historically that correlation has been maintained and the market follows a normal standard distribution where mean reversion is the norm. Now that's just the techie side of it, but essentially you get what I mean, that if gold and silver tend to go up and down in the same manner, but if one of them has gone out of whack, but eventually they're going to go back to how they're supposed to be. So essentially you can pretty much sell gold if you think that's going to go back down, or you can buy silver if you think it's going to go up again, or you could do both. Okay, so now let's move on to a different strategy, and let's take a look at strategy number 16, which is convertible arbitrage. Now this was very famous back in the 1990s, and some of the world's legendary traders started off by doing convertible arbitrage. Essentially what convertible arbitrage is, it's a type of trade which is inherently hedged by default, which is great. So for example, you buy a bond, you buy a convertible bond or convertible note in a company. Now this convertible bond starts off as a regular bond where you get your regular coupon payment, and then at maturity you get your $100. But a convertible bond, instead of getting your $100 at maturity, you have the option to convert that $100 in the company's shares. What this means is you get a regular coupon payment, and that's your upside, your profit instantly. But then at the end of the bond's maturity, at the end of its lifespan, if the stock has gone up, you get to convert it at a prefix price. Now, whilst you're also implementing this, you're simultaneously shorting the stock. So if the stock actually goes down instead, well, because you've already shorted it, you get a profit, but you also get to keep your coupon from going on the long side as well from your convertible bond. Now you're just not going to convert it, you're just not going to convert your bond. You're just going to keep the coupon and get your cash out, but also benefit from being short the stock. But if the stock did go up, now your short is going to be in the red, but you can cover this position by converting your bond into getting shares, and you can then use those shares to cover your short. So as long as the company doesn't default, you're always going to get your coupon. And if the company does go down, does decrease in value, you're already short the stock. Okay, so now let's move on to strategy number 17, and this is VIX, or trading the VIX. Now, there are various ways you can trade the VIX. You can pretty much, whenever the VIX spikes up because of a certain event, because of a certain movement, because of certain announcements in the market, the VIX tends to be mean reverting, where it always tends to go back down. So you can pretty much get an option in the VIX, or you can pretty much just short it outright. And you can pretty much do a lot of trades around the VIX. And again, this is the type of topic where it will take me pretty much 2 hours just to cover the VIX strategies. But essentially, VIX trading, it's its own security, and the VIX measures the volatility of a market. And it's the inverse of the S&P essentially. So it's the inverse of the market. So if you wanted to hedge the market, you can go long the market and go short the VIX, and then you're hedged, because if the market goes down, the VIX tends to go up. So other strategies is number 18, you have risk parity. Number 19, you have special situations. Again, check out those two strategies in the interview and recruitment guide, where we go into a lot more detail, as well as for all the other strategies which we've covered. Number 20 is special situation or unique situation. Now, this is very interesting. Recently, a lot of hedge funds have been created not to invest in the market as other traders would, but they invest in alternative markets. So say, for example, they will buy and sell luxury cars, they'll buy and sell wine, they'll buy and sell yachts, cars, planes. So you have hedge funds which invest in alternative types of assets. Some hedge funds would even finance litigation. If you want to sue a company, but you don't have the means to finance your lawsuit, you can go to a hedge fund and actually raise that capital, and then they will negotiate a profit and loss schedule. If you win, they get to keep X amount, etc., etc. But you have hedge funds which are now investing in alternative asset classes, and some of these are not even asset classes. I mean, who finances a lawsuit and considers that to be an asset? But again, you do have hedge funds which are pretty much venturing throughout the world of investing and finding new places where they can put capital to good use. Now again, if you are interested in learning more about the world of hedge funds, asset management, whether that's understanding more about the strategies or about the day-to-day life of an analyst, or pretty much the whole A to Z of what working at a hedge fund or asset management is like, then check out our guide on asset management and hedge funds, where we also go over interview prep, so teaching you how to prepare for your stock pitches, technical questions, and behavioral questions and answers. So check those out, and I'll see you in our next video.